Defining sovereign credit risk. Welcome everyone. Today we examine the critical topic of sovereign credit risk. Sovereign bonds are typically unsecured debt obligations issued by a national government. They are not backed by physical collateral, but rather by the government's taxing authority, its power to tax citizens and economic activity. Interest and principal payments usually rely on these tax revenues or the government's ability to roll over existing debt by issuing new bonds. It is a common misconception that sovereign debt is risk-free. While they serve as global benchmarks, these bonds carry real credit risk, meaning a government could potentially fail to meet its payment obligations. The diagram illustrates this fundamental structure. A national government issues a sovereign bond. This bond is backed by two primary powers, taxing authority over the economy and the power of money creation. Together, these mechanisms provide the funds for debt service. As a trainer, I want to emphasize that while the power to create money provides a safety net for domestic debt, it does not eliminate risk entirely. Over-reliance on money creation can lead to hyperinflation, which effectively erodes the value of the bond for the investor. Therefore, we must always look at the underlying fiscal health of the nation to gauge the true quality of its debt. Ability versus willingness to pay. When analyzing sovereign credit, we must distinguish between two vital concepts, the ability to pay and the willingness to pay. The ability refers to the actual economic resources and financial strength available to the government. Willingness, however, is a political decision to honor debts even when resources are tight. This is a critical distinction because of sovereign immunity. Unlike a bankrupt company, investors generally cannot take a government to court to force a payment. Therefore, a dual assessment of both economic capacity and political commitment is absolutely essential for every sovereign analyst. Following the logic tree on your screen, sovereign credit risk branches into these two parts. Ability to pay is driven by economic strength and available resources. On the other side, willingness to pay is determined by political will and the constraints of sovereign immunity. In my experience, most defaults aren't caused by a total lack of money, but by a political shift where the government decides that paying foreign bankers is less important than domestic social spending. As an analyst, you must be as much a political scientist as you are an economist to truly understand where a country sits on this risk spectrum. Local versus foreign currency debt. The currency in which a bond is issued drastically changes its risk profile. Local currency debt is issued in the country's own currency. This is generally considered safer because a government can theoretically print more of its own money to service the debt. However, foreign currency debt, issued in currencies like the US dollar or euro, carries much higher default risk. A government cannot print dollars, it must earn them through trade or hold them in foreign reserves. Furthermore, if the local currency depreciates significantly, the cost of servicing that foreign debt skyrockets, creating a massive fiscal burden. This decision flowchart clarifies the impact of currency choice. From the bond issuance we ask, what is the currency type? If it is local currency, the government can print money resulting in a lower default risk. If it is foreign currency, the government needs foreign reserves, which inherently leads to a higher default risk. As a trainer, I always tell my students, never look at a country's total debt in isolation. You must break it down by currency. A country with high debt in its own currency might be stable, but a country with even moderate debt in a foreign currency can be pushed into a default crisis by a simple move in the exchange rate. Key analysis framework, political and economic. To conduct a thorough sovereign analysis, we use a framework that balances political and economic factors. We look at institutional effectiveness, which assesses the predictability of policy making, the level of corruption, and the strength of the rule of law. On the economic side, we examine the economic structure, specifically looking at income per capita and the diversity of the economy. We also focus on growth prospects, as strong trend GDP growth indicates a country's ability to generate future tax revenue to service its debt. A history of stable growth is one of the strongest indicators of a high-quality credit profile. Looking at the mind map, sovereign analysis splits into political and economic pillars. Under political, we evaluate corruption levels and the rule of law. Under economic, we look at income per capita and GDP growth. For an analyst, these aren't just statistics, they are the character of the borrower. A wealthy, diversified economy with a strong rule of law will almost always find a way to pay its debts. Conversely, an economy that relies on a single commodity and suffers from high corruption is fragile, even if its current debt levels look manageable. You must look for long-term stability in these indicators to find true value in the sovereign market. Key analysis framework, flexibility and performance. Beyond structure, we must analyze a government's current financial performance and its flexibility to react to shocks. Fiscal performance is key, where we look at the debt burden, typically measured as the debt to GDP ratio. We also check external liquidity by comparing a country's foreign currency reserves against its upcoming external debt obligations. Monetary flexibility is also crucial. It tells us if the central bank is independent enough to control inflation without political interference. Finally, we look for twin surpluses, where a government runs both a budget surplus and a current account surplus, as this represents the ultimate level of financial safety. This class diagram organizes these metrics under financial _strength. We analyze fiscal strength via debt GDP, liquidity via foreign reserves, and monetary strength through inflation control. Together, these factors determine the risk level, whether it is high or low. As a trainer, I highlight that flexibility is what saves a country during a crisis. A government with low debt and high reserves has the firepower to bail out its banks or stimulate its economy during a recession. A government that is already stretched to its limit has no room to maneuver, making it a much more dangerous prospect for bond investors when the economic cycle turns. Credit rating agencies and scales. Given the complexity of sovereign debt, most investors rely on major credit rating agencies like Moody's, Standard, or Poor's and Fitch. These agencies summarize months of complex economic and political analysis into a single, simple letter grade. Ratings are divided into two main categories. Investment grade ratings bar 3 or BBB- and above indicate a high probability of repayment and lower risk. Non-investment grade, often called high yield or speculative, refers to ratings below those thresholds. These ratings are essential because they provide a standardized language of risk for investors around the world. The hierarchy shows the two paths for credit ratings. Investment grade ranges from the gold standard of AAA down to the cutoff of BBB bar 3. The high yield by junk path starts at BB Jod bar ban and goes all the way down to default by D. For an analyst, these symbols are the shorthand of the market. While you should always do your own research, you must know where a sovereign sits on this scale. Many institutional investors are legally prohibited from buying anything in the red, high-yield box, which means a downgrade to junk can trigger a massive sell-off, as these large funds are forced to exit their positions simultaneously. Impact of sovereign ratings. Sovereign ratings have a profound impact on a country's economic health. A high investment grade rating provides market access, allowing a country to easily tap into global capital pools. It also results in lower borrowing costs, as investors demand less of a risk premium. Furthermore, a sovereign's rating often creates a ceiling effect. It is very rare for a company's credit rating to be higher than the rating of the country it is based in. Ratings are designed to be stable and look through short-term economic cycles, providing investors with a long-term view of a nation's fundamental creditworthiness. The flowchart tracks the positive ripple effect of a sovereign rating upgrade. It leads directly to lower interest rates and more foreign investment, while also triggering corporate upgrades for local businesses. All these factors combine to drive economic growth. As a trainer, I want you to see that a rating isn't just a label, it's an economic engine. When a country's rating goes up, its whole economy gets cheaper to fund, which accelerates growth and creates a virtuous cycle. Conversely, a downgrade can be a debt spiral, as higher borrowing costs and fleeing investment make it even harder for the government to fix its underlying economic problems. Summary of sovereign credit quality. To summarize, sovereign credit quality is a complex mix of political and economic factors. We look for stability and wealth to drive the ability to pay, while payment culture and legal immunity define the willingness to pay. We have seen that currency is a primary risk divider, with local currency debt being fundamentally safer than foreign currency debt. Finally, we see that ratings provided by global agencies are the essential, standardized assessments that allow capital to flow efficiently across borders. Understanding these pillars is the key to navigating the global sovereign bond markets. Our final summary diagram shows the professional analytical loop. We first analyze _economy for strength, then assess _politics for willingness. We check _currency to identify default risk, and finally, we assign _rating to summarize our findings for the market. As a trainer, I hope you leave this session with a clear roadmap for analyzing any nation's debt. By focusing on these 4 steps, you can look past the headlines and see the true credit reality of a sovereign borrower. If you can master sovereign credit quality, you can understand the ultimate foundation of risk in the global financial system. Thank you for your attention.